To the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks. When you open a new Webull brokerage account, put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. I'm going to also send you a free Webull tutorial video to walk you through how to use the Webull app to make your first trade. All you got to do is DM me on Instagram at RichardFain28. Let me know you've opened your new Webull account. Let me know you've funded your Webull account. And I'm going to send you that free tutorial video so that you can start building wealth today. November 1st, 2 p.m. Eastern Time, the Federal Reserve will make a decision on short-term interest rates, whether to increase short-term interest rates, decrease short-term interest rates, or keep them steady. Pause. That's going to be decided by 2 p.m. Eastern Time today. After they make that decision, the Fed chair, Jerome Powell, will be making comments to the American people at 2:30 p.m. Eastern Time today. It's extremely important, guys, that you tap in to that particular 2:30 meeting, press conference, whatever you want to call it. Fed chair will be speaking. Now, if you can't tap in at 2:30 Eastern Time today, then go out and find it on the internet, right? Pre-recorded, recorded, whatever you want to call it. Find it on the internet. You need to hear that message today, guys. It's extremely important we know what the Fed's forward thinking is, because that's going to help us as investors be better investors, right? If we know exactly what the Fed is looking to do in the future, the near future, it will help us position ourselves to invest better, make better decisions as investors. Now, it's widely expected that the Federal Reserve will not increase short-term interest rates today, right? It's like a 98% chance that they won't. Now, that's from all these so-called experts out here making that prediction. Again, I don't take anything for granted. What I do is I watch, I listen, and then when they make the decision, I act accordingly. More important than whether they increase rates or not is what the Fed chair says at 2:30. Because of that forward thinking, that guidance is going to help me be a better investor. One thing I believe we will hear the Fed chairman say is that they're going to hold interest rates higher for longer. So short-term interest rates right now are 5.5%. That's the Fed funds rate. They're going to hold that rate at 5.5% for longer. And the reason they're doing that is because of our growing economy. See, our economy in the third quarter of this year grew by almost 5%. And that's not good, guys. You know, despite the fact we got high inflation, right? Despite the fact that the Fed has raised interest rates a historic 12 times over the last 20 months, our economy is still growing at a 5% clip. That's not good for inflation, guys. It really isn't. And my thought process behind why the economy is still doing it is because we still have a pretty resilient, red hot labor market And we have some wealthy people in this country and wealthy people around the world who make investments in the United States that continue to drive our economy. So the Fed is going to leave interest rates higher for longer so that more financial pain can be felt. And hope that this economy will slow down a little bit and not be growing at a 5% pace. See, they can't reduce interest rates, guys, if our economy is growing at a 5% pace. Because really, our economy should be only growing at around 2%, right? Right? We want inflation around 2%, and we want the economy growing slightly above that. That way, the Fed believes that's where our economy is the healthiest. But if we got interest rates at 5.5%, we got inflation at core inflation at 4%, and the economy is still growing at a 5% clip, something's wrong. And the Fed knows that. So don't look for the Fed to reduce interest rates today. Look for them probably to pause, not hike at all. But when you hear the Fed chairman speak at 2:30, he's going to say, we're going to keep interest rates higher for longer. What does that mean? That means they're not going to bring the 5.5% Fed funds rate down under 2% no time soon. So what's probably going to happen is 2024, 2025, by the end of 2025, you may see the Fed funds rate at around 4%. So that's higher for longer, right? That's what they mean, or the Fed chair means when he says higher for longer. That means they're not going to go from 5.5 to 2% anytime soon on the Fed funds rate. They can't do it. Cannot do it. Not with the economy as red hot as it is. Not with inflation still at 4%. Well, core inflation. Now, later on this month, probably in the middle of this month, you're going to get the CPI inflation report for October. That's going to tell us a lot. It's going to tell us a lot about where we are with inflation. We're going to also have a jobs report coming in on Friday this week. That's going to tell us how many new jobs the economy has added. How many new jobs have been added to the economy? So that report is going to be important. But it starts with today's Fed meeting. They're going to make a decision on short-term interest rates. Like I told you earlier, 99% of the experts out there believe they will not increase short-term interest rates. But you need to be paying attention to find out yourself. You also need to be paying attention at the 2:30 meeting. Like I said, if you can't make the 2:30 meeting live, then go out and catch it on the internet, right? After the fact. But you need to know, because without knowing what's going on, guys, with the Fed, it's going to be hard for you to make the right decision when it comes to your investment strategy. That investment strategy is going to be real important, right? If you're trying to build wealth, that's why you should be paying attention. You can't become a good investor without knowing what's happening with interest rates, without knowing what's happening with the economy, without knowing what's happening with inflation. You can't be a good investor. You got to know the basic information about these things. That's why I always encourage you guys to pay attention when the Fed chair is speaking. Again, you're not trying to be an expert. All you're trying to get an idea is, what is this person telling us the Federal Reserve is going to do when it comes to interest rates? I keep telling y'all, the Federal Reserve controls the money supply. When they turn on interest rates, when they turn on the money supply, they're doing what? They're lowering interest rates. When they turn off the money supply, they're increasing interest rates. Right now, they've turned off the money supply for the last 20 months. Why? Because they've increased interest rates, I believe, a total of 11 or 12 times, right? So that's what they've been doing. They've been turning off the money supply over the last 20 months. And what the Fed chair is going to tell you today is, how much longer will they keep the money supply off? They will give us some indication of that at 2:30 p.m. Eastern time today. So you need to be paying attention, right? When interest rates come down, money supply is turned on. When interest rates go up, money supply is turned off. If he says we're going to keep rates higher for longer, that simply means the money supply is going to be turned off for a longer period of time. That's what that means. So you need to be paying attention and adjusting your investment strategy accordingly. That's what I'm going to be doing. So I'm going to be paying attention today. And if I hear him say phrases like, we're going to keep interest rates higher for longer, I know the stock market is not going to thrive like it would thrive if interest rates were lower. So if he says interest rates going to be higher for longer, I know, okay, my strategy should be what? Continue to buy through dollar cost average my favorite ETFs and my favorite individual stocks and my favorite ETFs because they're going to be on sale longer. That's what that tells me. That simple phrase, interest rates will be higher for longer, tells me as an investor, especially if I'm buying paper assets, that guess what? Over the next couple of years, you still got an incredible opportunity to buy these companies at a discount. Because when the Fed funds rate is at 5.5%, guys, the stock market is not going to go into a bull market. It's not. You'll see a bounce every now and then, but it's not going to be consistent. It's not going to be consistently going up like it will in an environment where interest rates are low. You got to understand, interest rates are very important to our economy. It's very important to the businesses operating in our economy because the majority of these businesses have to borrow money in order to invest in their growth. And when interest rates are this high, they cannot afford to borrow money. So they tend not to grow. That's why you see so much volatility, in my opinion, in the stock market. Because the stock market is just made up of companies. So it makes sense, if I'm going to be investing in paper assets, it makes sense to pay attention to what's happening today with the Federal Reserve meeting. The meeting started yesterday, October 31st, and it's concluding today, November 1st. And at 2 p.m. today, the Fed will make a decision on if they're increasing short-term interest rates. If they do, then they'll do it probably by 25 basis points. If they don't, and they just decide to say, we're going to pause, then nothing happens. But at 2:30, the Fed chair is going to come out and tell you why they did what they did. And then he's going to give you some information for the near future. Here's what we plan on doing. And you just got to read between the lines. And if he says something like, we're going to keep interest rates higher for longer, you know, as an investor in paper assets, okay, here's an opportunity for me to continue buying at a discount. Because the stock market is not going to go into a bull market with interest rates, Fed funds rate at 5.5% and the prime rate at 8.5%. It's not. The 30-year fixed rate mortgage rate at 7.5%. Not going to happen, guys. You may get a bounce, but it's not going to be a prolonged bull run like we're waiting on. So until interest rates come down, me personally, I'm going to continue buying paper assets at a discount because I know they're going to be on sale. So when people ask me, hey, what's your opinion on the stock market? Well, it's a perfect time to build wealth. That's my opinion. Especially with Fed funds rate at 5.5%, it's a perfect time to build wealth because you can buy all of these great companies and these great ETFs and these great index funds at a discount. So why wouldn't I take advantage of that? If I'm a long-term investor, right? If I got 3, 5, 7, 10 years or longer to wait, it's a perfect opportunity for me to pick up these assets. We've seen a little bit of that over the last couple of weeks, especially in the last week. When you look at the stock market, what happened last week, it was red all week. You got great companies like Apple trading in the 160s per share, man. Come on. That's crazy. Apple is the most valuable company in the world, guys. And it's trading in the 160s per share. How could you not pick that up? At least for me, I did. You saw the Vanguard S&P 500 VOO go below $400 a share, guys. I'm telling you, it's These companies and these ETFs and these index funds are on sale for a reason. They're on sale because of interest rates being so high. And these companies in the S&P 500, right? These companies in the S&P 500, a lot of them borrow money to grow. And they can't borrow money cheaply right now, so they're not growing. When you look at the S&P 500 and you take a look at the top 7 companies in the S&P 500, right? And they call them the Magnificent Seven. Those top 7 companies are driving 28% of the value of the S&P 500. They're driving 28% of it. That's a huge number, guys. So the other 493 companies are driving 72%. That tells me a lot of those companies are not growing. And the reason they're not growing is because of interest rates being too high right now. So as long as you understand that concept, you'll also understand it's a good time to think about buying paper assets, especially if it's good, strong blue chip companies. It is, in my opinion. Now, again, I'm not your financial advisor. I'm not trying to tell you what to do with your money. You do what you got to do. But y'all know on my YouTube channel, it's about trying to give you guys my personal insight to what I think is going on, in hopes that some of you guys will start paying attention and picking up some little things and tips and nuggets that you can incorporate into your financial pathway, right? We all are trying to get where? We're all trying to get to that pot of gold at the end of the rainbow. That's where we're trying to get to. But we don't get there unless we understand how to build wealth. Now is not the time. If you're going to use paper assets to build wealth, now is not the time to be running and hide. Now is the time to be thinking about, okay, where can I pick up some discounts at? Where can I invest through dollar cost averaging and pick up some discounts and be prepared to hold those discounted assets for 5 years? Because this will turn itself around, guys. We just don't know when. If rates are held higher for longer, it's going to take longer to turn around. Because again, the stock market does not thrive at its best when interest rates are this high. They don't, because companies make up the stock market. And if companies can't borrow money to grow, they can't become more profitable. If they're not more profitable, their stock price doesn't go up. Their stock price goes up when they deliver profits, guys. When they deliver profits, that's when the stock price goes up. And right now, we already know 493 of the Fortune 500 companies, or the S&P 500 companies, are not pulling the weight. The top 7 companies are pulling all the weight. And all those companies are tech companies, right? They're all tech companies that are pulling the weight. They are pulling the S&P 500. You take them 7 out, S&P 500 is negative this year. It's negative. Negative ROI. You pull those 7 companies out, it's a negative ROI. And those 7 companies are Apple, Microsoft, Meta, Amazon, Alphabet, Nvidia, and Tesla. Those are your 7 top companies in the S&P 500 right now that are pulling 28% of the weight. And those other 493 are pulling 72%. So they're not pulling their weight. And a lot of those companies are not pulling their weight because they can't borrow money cheaply to invest because of high interest rates. So yes, the Fed meeting today is important because it will give us some indication of how long interest rates are going to be higher. For how long? It'll give us that indication, or at least we can listen to the Fed chair to see if we can find any forward thinking that we can take and incorporate it into our financial pathway to financial freedom, right? That's the key. We got to know what's going on with the economy, guys. We got to know what's going on with interest rates. We got to know what's going on with inflation. And I've already told you, the jobs report is coming out Friday. Pay attention to the jobs report. If we're still adding hundreds of thousands of jobs, guys, I'm telling you, our economy is going to continue to be hot. Because as long as people got jobs and as long as they get wage increases, Hey, they're going to spend money. That's what we do. That's what our economy is built on. Our economy is built on people earning and spending. It's 70% consumer spending. So if you got a lot of jobs out there, that means people ain't really worried about losing a job and not being able to find another one. If they're getting wage increases, people going to spend. That's what they do. That's what our economy is built on, consumer spending. So if you know that, then you'll know the rates are going to stay higher, because the Fed is going to keep rates higher to force inflation down and to force people from spending. Now, people stop spending, inflation comes down, right? It's all that supply versus demand, right? If there's a lot of money in our economy, if there's a lot of access to money in our economy, people spend. And when people spend, when they overspend, guess what happens to the supply versus demand equilibrium? It's off balance. Because if there's a lot of money in our economy and people are spending more, but our supply can't keep up with that demand, prices go up. That's why you see inflation, core inflation at 4%. That's why back in June of 2022, headline inflation was 9%, because of that imbalance, that demand versus supply imbalance. And what the Fed has been doing over the last 20 months is trying to get it back into balance. And the way to get it back into balance, one of the ways, or the main way, is increasing interest rates. The thought process is, if we increase interest rates high enough, what we do is we turn off the money supply. And if we turn off the money supply, people will have less money to spend, companies will have less money to borrow, and we can bring back the balance between demand and supply. That's why they increase short-term interest rates. Has that worked? I think it has. To a certain extent, it's worked, because we went from 9% headline inflation in June of 2022 down to 3.7 headline inflation. So it's worked. Problem is, they haven't slowed down the labor market, though. Right? That's the problem. They haven't slowed that down. And that's where the pain is God, dog, we done brought down inflation, tremendously, but we can't get it to the 2% because we got this labor market. We got these jobs that are being added to the economy every single month in the hundreds of thousands. That's the problem. That's the problem. You add, last month, labor jobs report came out last month. 300,000 jobs were added to the economy, guys. I'm talking about last month, which is insanity. It's insane. So be on the lookout this Friday to see how many jobs are added to the economy. Is it going to be 300,000 or better again? I don't know. Now, what the analysts, all these so-called experts, are predicting, it'll be about 190,000 jobs. Did the same thing last month. They predicted some low number. It came in at 300,000. Shattered it. So we'll see. We'll see for October. We know what September did. September added 300,000 new jobs to the economy, which was not good. We're going to see what October is going to add, because that's the key, right? That's what the Fed is saying. The key is, if we can slow down this red hot labor market, perhaps coupled with high interest rates. See, high interest rates has turned off the money supply for borrowing. But you got to turn off the money supply through the labor market as well. Not raise unemployment to 10%, but you got to get unemployment up. And you got to slow down adding as many jobs to our economy. That's the other piece of the money supply they're trying to turn off. The main money supply that they've turned off is borrowing money, right? Because they've increased interest rates, you can't really borrow money anymore, right? But the other one that they've been trying for the last 20 months to slow down is the labor market, and they haven't done that. And that's why you see inflation still above 4%, core inflation. That's why it's still above 4%. They can't turn off the labor market. I mean, they've tried, but it hadn't worked. So now what they're saying is okay, we recognize we've brought inflation down quite a bit, but we also recognize it's still being sticky at that 4% range. Core inflation is still being sticky. And we believe it's being sticky because of this unrelenting labor market that we have. So what we're gonna do, we're not gonna keep raising interest rates too high because we don't wanna throw the economy into a recession. But what we will do is we're gonna keep interest rates where they're at for longer. And let's see how the labor market survives keeping the Fed funds rate above 4% for the next 2 years. And that's what they're gonna do. I think that's what you'll hear today. Maybe not in those exact words. Obviously, the Fed chair may say what he wants to say, but I'm giving you my opinion. That's what I do on this channel. I give you my opinion. You guys have to make your own conclusions and come up with your own opinion and conclusions. I'm just giving you what I think will happen. But don't take my word. Pay attention. Get your butt somewhere where you can watch the Fed chair today. If you got a smartphone and you got internet connection, watch him. Listen to what he's saying. See how that will impact your wealth building plan. Be on the lookout for this higher for longer when it comes to interest rates. If he says higher for longer, that's 2026. You're going to see interest rates still 4% or better. And that's Fed funds rate. So if Fed funds rate in 2026 is 4%, then prime rate, which is what most consumers borrow money from banks at, is going to be 7%. That's the way it is. Now, he may even go as far as saying, and also, let me let y'all know, we may increase interest rates again. Because remember, they got another meeting in December, guys. Middle of December, they'll have their last meeting for the year. So he may even say, we're going to hold interest rates higher for longer, and we always have the option of increasing short-term interest rates at a later date. And that later date is going to be December, right? Or on into 2024. The Fed controls the money supply through interest rates, so they can jack the interest rate pretty much anytime they feel like they need to. I think they're comfortable at the 5.5. They may bump it one more time, 25 basis points to 5.75, but I don't think they'll go any higher than that, even next year. I think the key though is they leave it at the 5.5 if they don't bump anymore. If they leave it at the 5.5 for longer, if they leave it there, guys, over the next couple of years, I'm telling you, man, there's going to be some pain. Because that's going to mean these companies are going to have a prolonged period of not being able to borrow money cheaply over the next 2 years. So in my opinion, the stock market does not thrive until they reduce those interest rates. I mean, significantly. But if you're in the building stage of wealth and you're looking to buy blue chip assets on sale and you got a long-term hold pattern, you can buy them today, you can buy them in 24, you can buy them in 25, and then hold them to 26, 27, 28. That's how you build wealth. But we got to have some patience to do that. And a lot of us are programmed not to have patience. A lot of us are programmed to want it tomorrow. Oh, I bought VU today. It looks like it's going down in value. Should I sell it? Why would you do that? Number one, why would you even buy VU if you're not planning on to build wealth and hold it long term? Long term means long term, guys. It doesn't mean, oh, I held it 3 weeks. That's long term. That ain't long term. If you're going to invest in paper assets, especially in the environment we're in today, guys, you better be prepared to hold them long term. You're not going to turn a quick profit. Not most of us, not 99% of us. We're not. And we shouldn't be looking to get rich quick. If you're looking to get rich quick, go down to Las Vegas. They got a lot of casinos there. You can walk in there, have your lucky rabbit's foot in your pocket, and maybe you can get rich quick there. But the stock market is not Las Vegas, man. You can't get rich quick if you don't know what you're doing. And 99% of us don't know what we're doing. I don't know what I'm doing. All I can tell you is my last 25 years of not knowing what I'm doing, I just decided, you know something? I'm going to buy blue chip. who have a proven track record of success, and I'm just going to keep the money in there through dollar cost averaging. And what I've learned over the last 25 years, I didn't need to know anything other than that. It's proven. So I didn't need to be the expert. And a lot of us have to stop thinking we need to be the expert. No, you watching the Fed chair today at 2:30 has nothing to do with you trying to be an expert. It has everything to do with you trying to get some level of understanding of how our financial system works in this country. A lot of us don't want to know how our financial system works, but we expect to be building wealth through paper assets or real estate or anything else. You're not. You got to have the basic information about how this thing works. Money supply is turned on when interest rates go down far enough. Interest rates go under 2%, money supply is turned on. Interest rates go up the way it is right now at 5.5% or higher, money supply is turned off. But there's a reason they turned off the money supply, because they flooded the economy with free money 3 years ago. And when you flood the economy, when you turn on the money printer, and you flood the economy with all that free money, that cheap money, at some point, it's going to drive up prices. And in order to drive those prices back down, you got to take all of that free money back out of the system. And that's what they're doing now, guys, in a nutshell. Now, again, I'm no expert. There are other people out there with a lot of letters behind their names and all these, they own TV and all this stuff. They'll tell you some more complicated version of that. But in a nutshell, that's what it is. That's all it is. But you know that little basic little piece of information right now, it makes you a better investor. It also gives you a level of patience. Because if you know this, if you know interest rates are 5.5%, you already know the stock market is not going to thrive. Not like it will if interest rates were 2%. It's not. If Fed funds rate is 0, people borrow money left and right. Businesses are borrowing money, and they take that money and they put it in growth. That's when we're going to thrive. We're not going to thrive in the stock market at 5.5% Fed funds rate. It's not going to happen. You'll get a bounce every now and then, but you're not going to get that rocket ship. But until the rocket ship gets ready to take off, what you should be doing is buckling yourself in through dollar cost averaging, buying your favorite ETFs, buying your favorite individual stocks, buying your favorite index funds. That's what you should be doing. In my opinion, again, not your financial advisor, all I can tell you is if you want to build wealth and you want a pot of gold at the end of the rainbow, when you get there, at some point in the future, it don't magically happen. There is no leprechaun at the end of that rainbow looking at you like, okay, let me sprinkle some fairy dust and you're going to have some money in your retirement accounts. You're going to have some money in your nest egg. No, there's no leprechaun there to do that. You the leprechaun. But you got to be smart, leprechaun. You got to be smart. You don't have to know a lot, but you just got to be smart. And that's why I encourage you guys to pay attention today. Please, pay attention. You ain't got but a couple hours. This thing is going to unfold itself. And then I want you to pay attention on Friday this week. What is that? November 3rd, I think. That's when the jobs report's coming out. It's going to tell you what the economy is doing, man. It's going to tell you. Them job numbers are going to tell you. Like I said, estimates are coming at 190,000. If it's more than that, I mean, way more than that, interest rates going to stay higher for longer, guys. I'm telling you. I'm just telling you. If it is, they're going to stay higher for longer because the Fed can't have that. The last thing the Fed wants to do is take their foot off the interest rate pedal too soon, and then inflation goes back up to 7%. They're not going to have that. So the only way to prevent that from happening is they're going to keep interest rates elevated for longer until they have a really, really, really good idea that the labor market is under control and that what? Inflation is under control. That's when you'll see them start reducing short-term interest rates. Now, a lot of people are thinking they'll reduce. Not a lot of people. I mean, if you looked at the last Fed chair remarks at their last meeting, he indicated June of 2024 as where they would estimate potentially starting to decrease. But you got to understand, when they say decrease, guys, they don't mean go from 5.5 to 2%. What they mean is around June of 2024, there's a possibility they could start decreasing short-term interest rates by 25 basis points. That ain't a lot. Not when let's say they bump one more time and we get to 5.75. And then in June of 2024, they decide, let's reduce by 25 basis points. We're still at 5.5, guys. And let's say the next Fed meeting, they do another 25. We're still at 5.25. So they're not going to reduce from 5.5 or 5.75 down to 2 in one or two Fed meetings. They're not going to do that. The only time you might see them do something like that drastically is if all chaos break loose and the economy is spiraling down into a prolonged recession. They may do something drastic like that to stimulate the economy, because they already know all they got to do in order to stimulate the economy. If the economy is free falling and just being destroyed, all they got to do, man, is lower interest rates and turn the money supply on, and then the economy will stimulate itself. See, the Fed knows that, but they don't want to do that right now because the economy is still already growing at 5% in the third quarter of 2023. Why would they reduce interest rates? Because if they reduce now, the economy might grow at 8%. And then guess what's going to happen? Inflation goes right back up. So they're not going to reduce right now, especially with GDP for the third quarter close to 5%. They're not. Don't even look for it. It's not going to happen. Not going to happen, right? So let's focus on what can happen. What can happen is we can look at buying some assets right now. That's where we should be focused on, some assets. We should be focused on assets right now. Gathering as many assets as we can, blue chip assets, that we can hold 3, 5, 7, 10 years, depending upon whatever your wealth building strategy is. For me, it's a 10-year hold. Everything that I'm buying today, index funds, ETFs, they're for 10 years down the road. That's my plan. So for me, I'm like, shoot, the whole concept here is to buy low, sell high. Now, makes sense to me if I can buy low for the next 2 years and then in 10 years sell high. That's the upside I'm looking for, guys. I'm looking for that type of buy low, sell high. That's how you make money with assets, guys. I don't care what asset it is. The goal is buy it at one price, and then when you're ready to exit that asset, you sell at a higher price. That's the concept. The concept isn't to buy it at a higher price and exit it at a lower price. No, that's not the concept. So if I'm at the top of the market, why in the hell would I want to buy anything at the top of the market if it has nowhere to go but down? I want to buy it at a price where it's not at the top of the market. Like today, these assets are not at the top of the market. They're not. Like I told you, VOO, under $400 a share. I believe it's like $380, and it could be dropping. Tesla, under $200 a share, guys. It may drop further. I don't know. But I also know within 5 or 6 or 7 months, Tesla will be over $300 a share. That's how Tesla bounces. So if I'm an investor, and I've seen this cycle from Tesla over since the pandemic. Since the pandemic, I've seen this cycle with Tesla. Drives down the price, then all of a sudden it shoots back up. I've seen that for the last 3 years. So for an investor like me, I say to myself, okay, Tesla has a pattern here. It's a fast growing company. It has huge swings in its stock price depending upon what's going on. If I can catch it on one of those downswings, pick up Tesla, and then when it does have one of them upswings, I don't know, 3 months, 6 months, 9 months, 12 months, I just made some net worth. So that's what I do with individual stocks. I take a company like Tesla that I know has a history of huge swings in their stock price. I just catch them on one of those down swings. Like right now, under 200 a share, at least it was yesterday, I haven't looked at it today, but under 200 a share is, in my opinion, a downswing. Now, it could go further. I don't know. I just have to be comfortable with my target buy price and my target sell price. That's all I concern myself with. I can't worry about how much more it'll drop and get greedy. If it's under 200 a share, I pick it up. All right? If I can pick it up under 200 a share, and if it swings back to 250 a share, I sell it. Make me $50 per share. And then I move on to the next one. Now that's my short-term plan. My long-term plan is 90% of my money is going into ETFs and index funds. You guys have heard me say this many times, but I do take a short-term position every now and then in Tesla because it's just such a incredible company with huge swings in value in its stock price. And why not take advantage of that if you know it's going to happen and you know what the outcome is going to be, at least what history says. So that's where I'm at with that. But listening to the Fed chair today, guys, will give you some indication. And I just wanted to give you a heads up. Pay attention. I'm going to come back probably this afternoon with some more thoughts after the Fed meeting, after we know if rates are going to go up or stay put, after the Fed chair has his remarks. I'll come back later on this afternoon, maybe like 6 p.m. Eastern time today. I'll do another live and just give you my thoughts on exactly what the Fed chair said, because I'm going to be paying attention. I'm going to be listening. And I'll give you guys my feedback on that. But I appreciate y'all tapping in for a little bit today. Hopefully you will put yourself in a position where you can watch this thing unfold today. I hope you do. That was the whole purpose of this live stream this morning, is to remind you guys of that. And also, if you're in the video right now, in the live stream, hit the thumbs up for me, guys. We're a little light on the thumbs up, so if you can hit that for me before you tap out of here, I certainly would appreciate it. It goes a long ways to help with the algorithm, spreading this content out to more folks. And the whole goal here is we want to help as many folks as we can get to their financial freedom. So please hit the thumbs up for me. I really would appreciate that. Also, share the content. Share it with somebody in your network. That would be greatly appreciated as well. If you want them 12 free stocks from Webull, click on that link down in the description box. Open up your new Webull account today. Go get that free stock. Go get that free money. I'm also going to send you a Webull tutorial video. Once you open your Webull account, once you fund it, just send me a DM on Instagram at RichardFain28. Let me know you've done that, and I'm going to send you that free Webull tutorial video to walk you through how to use the Webull app so that you can start building wealth today. If you're stopping by the channel for the first time, please consider subscribing. Once again, share the video. Once again, hit the thumbs up before you get out of here. I really would appreciate it. Hit that thumbs up for me. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video.